Hello and welcome everyone to this important Tesla stock scenario analysis. Because as you know, we will go into June, we will have Robotaxi launch, and I discussed it a lot, what my Robotaxi launch model actually says and what we do about it. And what we want to do today is go into the details of scenarios. What is the stock likely going to do, or what could it do in May, and what could it do in June, and what does it mean for us as shareholders and for us as potential call options holders or LEAP options holders? That is the key question, and we want to jump into that. So if you are a stockholder and you just have Tesla shares and you hodl them, hold on for dear life, there's not much to say here other than that I'm very bullish. My long-term target of 11,000 for 2030, if we continue on the trajectory we are on. I think there are many reasons to believe we will continue Optimus and Robotaxi. And as shareholders long-term, I don't think there's too much to fear, not investment advice, but I'm all in on Tesla. Now, the problem is that some of us are very greedy, including me. And we see this enormous opportunity that Robotaxi and later on Optimus are going to present. And this opportunity is not just an enormous multi-trillion-dollar margin and profit stream, but it's also alpha, which means most analysts massively underestimate what's going to happen. And that's very good if you're into options, because it means you can get into something that is undervalued despite overwhelming evidence. Because the traditional way of doing things, the Warren Buffett way of doing things, does not apply anymore in a world where reality engineering has become the prevalent mode of value creation, as demonstrated by the wealth tables that you see. Who are the leading richest people in the world? Everyone in the top 20 is basically a technology entrepreneur, with the exception of Warren Buffett. But Warren Buffett is not number one. Elon is number one, then Jeff Bezos, Zuckerberg, and the whole crowd. So that tells you something is going on. And if you as an investor, or I as an investor, are smart and see these future developments early, then we can win. And Robotaxi is one of these great opportunities. Now, why is it so important to really zero in on what's going to happen in June and in May? As I explained, as a shareholder, not so important. Because if things go up and run into the Robotaxi launch, and then something disappointing happens and the stock crashes 20% or 30%, you as a shareholder don't care, because strategically, there's no reason, as at least for now, to be worried. If FSD hits a roadblock, it's going to get fixed very quickly in long-term timelines. Very quickly means maybe in June we flatline or have a hiccup. They have to stop doing Robotaxis. It's going to be terrible for the stock. But a month later, they put them back on the road. If they fail again, a month later, they're back on the road. Then they start to scale. If scaling is difficult, well, we get delayed another 3 months, and then we are back. At some point, it doesn't matter for a shareholder if we hit $1 trillion in profit through Robotaxis in 2027 or 2028 or 2029. It's not that important. But if you're a LEAP holder or a call option holder, being right but on the wrong timeline can wipe out 100% of your investments. As if you're greedy and into LEAPS, you have to be a little more tight in the predictive accuracy that we display here. Hey, creating these videos is a lot of work. Please like and subscribe. It really helps out the channel. Now let's get back to the video. So as a general rule of thumb, and I went into that in my LEAP model, I will cover more of the LEAP model very soon. You will see it on pioneerlands.net and the Pioneer Academy. You can download the model and see it. But what we want to avoid with LEAPS, LEAPS are long-running options, right? Call options that expire, in 2026, mid-2026, or end 2026, or beginning 2027. So we have some leeway. Normally you buy them out of the money, right? So if Tesla is at 345, you maybe buy a 500 strike price, long running option. And then if Tesla actually goes up to 600, 700, 1000, you have massive leverage, make much more than with stocks. The problem with LEAPS is, depending on the LEAP simulator, what it tells you is that LEAPS can lose massive amounts of premium if the stock goes down or sideways for a certain amount of time. And of course, we don't want that, right? We don't want to be in that trap. And here's an example. Even if we predict it goes up and Robotaxi launches and scales in June, but we are wrong and it gets delayed for 2 months, and even if it kicks in then, and in the end, it turns out our LEAPS, if we hold through it, are fine. Even then, we will lose 50% of capital, at least on paper, maybe 60, 70% of capital on these leaps in premium in that 2 months, right? So there is a time decay that is pretty dramatic. So ideally, we want to avoid going into any kind of phase that offers that level of risk. And it's all about predicting the future accurately and squeezing the future into probabilistic corsets that we think reflect the truth. And that's the exercise of this video. We're going to go into that. So let me explain how I approach it. And you see, this is all probabilistic stuff, but it's important to develop these frameworks in our minds so we have something to think with and to look forward with. Let me first explain the framework I set up here. This is a tactical framework. So this is about the robotaxis. And, how many, first of all, when we talk about the framework, I came up with these different scenarios. A hiccup scenario, which means something goes wrong at launch. That could happen. Maybe there's an accident. Maybe something bad happens. Who knows? Then a flatlining scenario where we launch with 15 robotaxis in at June 1st. Let's just assume it's June 1st. Maybe it's June 7th. Who knows? But at some point in June, we launch. That is confirmed. Elon says it's going to be 10 to 20 robotaxis Model Ys on day one. So we know that. Hiccup means 2 weeks in, June 15th, and 4 weeks in, we go from 15 robotaxis to 0 because they have to pull the plug and say, oops, something went wrong. We have to stop the commercial service. That's the worst case scenario. It's not the worst case, depending on what exactly happens. Of course, if someone gets injured, that's the worst case. But if they just say, oops, something is going really wrong, we have to pull the plug, that's a little less worst case. But my worst case, it's the hiccup scenario. And we go from 15 robotaxis deployed on day one to 0, 2 days, 2 weeks in, to 0, 4 weeks in. Yeah, that's the first scenario, right? Second scenario, we have flatlining. And in the flatlining scenario, we start with 15, 2 weeks in, we are at 15, and 4 weeks in, we are at 15. For whatever reason, they decide, there are lots of little problems. I don't want to scale this, says Elon. Let's keep it at 15 cars and keep testing this. Low means we go from 15, 10 to 20 to 2 weeks into 20. So we add maybe 5 or a few cautious scaling in the first 2 weeks. And then in 4 weeks, we had 30, which is actually doubling. So, slow is relative, but on a very low basis. And fast means, Tesla prepared this whole thing, tested it in San Francisco with employees and in Austin, and they tested the hell out of it. They're very confident. They just want to be cautious. They launch with 10 to 20. And then after 2 weeks, they say, you know what? We have tested this so excessively. Now it's live and commercial. Just scale it, just double it to 30. And then nothing happens. Everything is perfect. Everyone's happy. And they say, double it again. So within 4 weeks, we have 4x. That is a fast scale that no one expects, right? So let's go into what that means to Wall Street sentiment. And bear with me, we go into the strategies here and the stock price scenarios, at least some. So let's go into the Wall Street sentiment. What does it do to institutional investors? What happens in a hiccup? Now, here's the interesting thing. Some argue if you have a hiccup and they pull the plug, it's going to be a disaster. The stock goes to 0. The stock goes under 200. Well, I don't think so, because the expectations that Elon has set in the short term for June are super low. He says 10 to 20 cars. And first he said on day one, now he just says 10 to 20 cars. So everyone who's not a fanboy or deep into that stuff, everyone who's just an analyst says, okay, fine, do not factor in Robotaxi at all into cash flow in the next 24 months, right? This is not a thing that's happening, not even long-term, maybe super long-term, but this is just not happening. It will be a little pilot. They will just test it around, maybe like Waymo for years and years and years, and they will scale to 100 Robotaxis maybe next year. That is the expectation right now, right? And I'm not saying that Morgan Stanley and some other guys are not very bullish on the whole thing, but no one expects it to actually work. That is not priced into the stock right now. So hiccup means Wall Street is going to say, oh, what a bummer. Let's focus on cars and Optimus. They were basically going to say, oh, this is going to take way long and it's a bummer. And it's not really going to happen. I'm not super surprised, but I'm selling some shares. If we flatline, they will say, well, that's what we thought. This will take a long while, a long time. Let's just keep observing it, but we don't take this seriously as any kind of cash flow or profit EBITDA generator that moves the needle in any way in the next 24 months. Right? And that's kind of the line, 24 months. Is there anything big happening? Are we on a trajectory that really moves the needle for the company in the next 24 months? Slow. Well, actually, I call it slow because I have actually higher expectations than slow. But Wall Street would be already surprised, right? They would say, well, that's interesting. Why are they already quadrupling here or doubling in the first month? let's really watch this and, let's get a little more bullish maybe. And if you scale fast, everyone will be blown away. This will trigger FOMO, panic buying. They're going to, maybe not then, but maybe the month after. But for us internally, for the pros, we call you guys the pros, the people who know more than the average Wall Street analyst. We look at this like, wait, whoa. We are on the right track here. This is going to get very serious. So as you can tell, if you ask me what's going to happen, I think we are landing here. We could easily land here. We could also have hiccups and land here or here. So I don't even want to speculate too much. That's why we have the scenarios. So we are prepared. Okay, what does it all mean? I'm going to go into the scenarios right now. So if you have a scenario 1, run up. So let me explain this. These are not scenarios. These are basically, we have to, it's a multi-dimensional chess game we are playing here. So we have basically 2 dimensions of scenarios. You have what I call scenarios, which relates to where the stock price goes in the next 2 weeks. That's my scenarios 1, 2, 3. And then we have these trajectories. Are we on the hiccup trajectory, flat, slow, or fast? So when I say scenario 1, now I'm referring to, okay, let's assume, because our decision-making time is not in May. In May, I'm holding through. I'm just sharing with you guys what I'm going to do. I hold all my leaps. I'm not doing anything until June 1st or whenever this thing launches. I'm not going to do anything. I think right now we're in a good position to run up more because macro looks good. The markets look good. June is coming up. So for me, the question is, how does the stock behave until then? And what do I do then? Now, if the stock price, and this is highly speculative, I will explain it in a second why it's important. Let's say scenario 1, we see a run up into the event. So we get to 400. And then my prediction would be, if we have a hiccup, we are selling off 20%. If we are at 400, because run up means people have a higher anticipated success, right? They say, well, maybe there is something here. The hiccup would mean, no, there's nothing here. The doubters were right. They have many problems. You have to discount Robotaxi. Nothing gonna come out of this in the next 24 months. So we need to go back with the share price to anticipate Optimus and the affordable models and everything. So I think 20% sell-off from 400 in terms of hiccup is realistic. I don't think this goes lower, but let's see about that. And I think then by June 30th, they will have forgotten about Robotaxi and say, okay, let's focus on Optimus and the affordable cars, and the market will be bullish probably, and then we end up 40. I think that's a realistic scenario in scenario 1 in case of hiccup. Now, in case of flatlining, I think there will be a natural sell-off, sell the news, right? So there's basically the anticipated scenario, same with here, slow and flat, will be anticipated scenario, which means we are selling off, right? We run up, the stuff we expected happens, and we sell off. That happens with events. So we see a 5% sell-off, maybe something around that. And if we flatline and nothing happens, we could sell off more, 10% maybe. That's what I think. If we go into the slow trajectory, same thing. We start slow, same thing. We are selling off 5%. But then we see, oh, this goes to 30 and they double it in month 1. Okay, let's buy it up again. So we start going up again, and we have to see what happens then. If we have fast, we trigger FOMO. Fast will trigger the FOMO situation because analysts are going to be forced to say, my God, if that continues, maybe it's game over. And now we're getting very nervous. Now we have to panic. Now we have to say, buy this stuff. I think then we are going up like crazy. What's very important here is I want you to think in percentage, not in absolute terms, because we cannot predict what that number is. Like, what if it runs up to 480 or 420 or 430? What if it happens to run up to 380? Like, we don't know that exact number. So you have to think in percentages here. These are my estimates. The absolute numbers are just relative to this. Why is this so important? So it's so important because what I'm saying here is not pure speculation, right? What is not speculation is these things have to be measured. We have to measure them so there won't be speculation. These are just firm future scenarios, and one of them will become more true than the others. So this is just a question of measurement, not speculation. And then this here, well, that's also not speculation. Something is going to happen before June 1st. And then this here is speculation, right? The speculation, if this happens and if this happens, what happens to the share price? Of course, I cannot guarantee if we have 400 and we have a fast trajectory that it goes to 480. It could go to 580. It could go to 420. Who knows? But here's what I do know. We have these little things here. And these come from the model that I was sharing with you guys, where we model out the actual EBITDA contribution. So here, this is not share price speculation. This is what's going to happen on the different trajectory: fast, expected, slow. The hiccup I kicked out here. So it's basically, it's basically fast, slow, and flat, because, I stretched slow and fast out into 3, basically. So blue is very close to flat. But what you see here, the green line is $12.4 billion in EBITDA. That is 2024. That's basic profit, right? So the profit of Tesla in 2024 was the green line, 12 billion. And so you see what's happening here. And that is 2026, end of 2026. And in December, this will already be clear, in December 2025. And if you're smart and you zoom more in, so this is monthly: June, July, August, September, October, November, December. You can see that these expected trajectories are driving very quickly up, and they're driving very quickly into these annual ones. And that's what the analysts have to recognize. Hey, if you want to stay ahead of capital markets and the next Tesla moves, join us in Pioneerlands. Here we track Tesla, capital opportunities, AGI disruption, and politics. It's your critical information advantage in the age of AGI. It's free, and the link is in the description. Let's get back to the video. The analysts have to recognize, if Robotaxi turns out to double the entire profit of Tesla, it's game over, because they know what happens next. It's quadrupling, tenfolding, and so on. And we are on track to these 2,000, 3,000, 4,000 price targets just on Robotaxi that ARK and others are talking about. So, we have to connect these dots, and that means if these things happen, right? If this scenario happens, the reason I'm saying 480 by end of June is not that I can guarantee it's 480, but I can guarantee you, if it's not 480, the growth of Tesla and Robotaxi will force the share price in line with my projected model, which means if it's lagging, Wall Street is too dumb to understand that, you're just forcing it to go to 600 in September, and so on and so forth. So I don't care how long it lags. The longer it lags, the more exponentially it has to go up, and everyone knows it. So that's how you have to think about it. And that's why you want to go all in. In this case, cannot stay irrationally much longer than you can stay liquid, because we have a hard forcing function of profits. It's that simple. So that's why this is important. That's why I'm pretty optimistic or bullish on this whole projection. So let's go into scenario 2. Let's assume the stock goes to 360 by June 1st. So basically flat. We had 345, so it hovers around here. Not much happens, goes up very incrementally. In that situation, if you have a hiccup, I think it also goes down to 320. Fast, it also goes up to 480. So it doesn't matter too much if it stays here. I think these numbers don't change much. And then finally, scenario 3, if it drops from here for whatever reason, something bad happens, people lose faith, whatever, and we go below 330 from here, so down 5% from where we are now in the next 2 weeks, I think, of course, then a hiccup can lead to further downwards pressure, and we go 300 or below. But I think the fast trajectory will catapult it to pretty much the same place. So, and these are all very speculative. I just want to give you a sense of how I think in scenarios. What does it all mean? Well, here's what it means. Here's the LEAP strategy. This is the options strategy. All of that stuff is especially and only important for options investors. We are not options traders. We are options investors, because we have a long-term conviction in Tesla, and we just use options to leverage. So what it means, in a run-up scenario 1, here's exactly what I'm going to do. If I see the stock running up, the downside gets much bigger in terms of percentage, and the gains, are much easier to capitalize on. So what I'm going to do is, here we have the live stream chat. And what I'm going to do is, I'm going to reduce my LEAP portfolio. That is currently 50% of my entire Tesla position. So I'm a little deep in LEAPS, because I knew this is ridiculous what's going to happen. So I shifted shares into LEAPS. I want to reduce it by up to 50%. Okay? I want to reduce my LEAPS by up to 50%, because when you think about the downside, if you go up to 400, if anything bad happens, you will lose a lot of money on paper with these LEAPS short term. If we go sideways, I know what premium decay means in out of the money options, also with the LEAPS. You just get murdered. You lose 50% of the value. So I don't like the risk. And especially if you go up here, even in the bull scenario, I don't think, in most scenarios, we are just losing money in the first 2 weeks. And I will go into that in a second. Because in the first 2 weeks, what do you expect is going to happen? like nothing good really can happen in the first 2 weeks, right? We launched at 15 robotaxis. Like, what do you imagine would happen? Like, of course, they could come out in week 2 or week 1 and say, you know what, it's all perfect, let's double it. I'm not saying this cannot happen. It can happen, and then we lose out. But there's so much upside, who cares? But it's much more likely that they just tinker around. They don't even tell us if they deploy more. So in that case, it's a guaranteed sell-off, in my opinion. It's just going to sell off because, you know, in the first 2 weeks. So I don't like it. And then if anything happens, we are in for like a little winter for a few weeks or months even. And then our premiums will look very, very bad. So if it goes up to 400, I think it's a good reason to reduce the leap position up to 50% if you have a big leap position, right? You know, but that does not mean we are selling it and we are out of it. Because in my opinion, the slow or fast trajectory are much more likely than the hiccups or sideways or flatlining. So we want to basically track super closely what trajectory we are actually on by June 15th, day by day. Of course, it could happen any day. If we get any signals here that this rollout is smooth, any signal, we need to act fast and go all back in. So that's my risk mitigation here. This way I feel much more comfortable. If I lose out on some upside because suddenly on day 3 they just double the cars and announce it on X, yeah, sure, stock goes up 10% and we lost out on it, but we are still in with a lot of leaps, and the downside risk is just too high, in my opinion, in these first weeks, because why would it not sell off? So I think selling off a little bit, reducing the risk and leverage is the smart move, and then get super close in tracking everything that's happening on the ground. And once we realize we are on any of these trajectories here, the red or yellow, I think it's time to absolutely double down, and we will discuss how we double down, right? If it's fast, if you're on the fast trajectory, more short-term options might become an interesting scenario December 25, but this is extremely risky because you're totally screwed if something goes wrong. And if it's like clear that this is going to work, but there's still some hiccup risk, then you more go towards December 26, 127 expiration with strike prices. I mean, what I like right now, I'm just sharing my preferences here. If you had 400, a 500 to 600 strike at December 26 gives you a reasonable situation that is actually pretty nice, high delta, everything. If you go too much out of the money to 900 or something, it's just very painful to see your time decay. And if you're on the fast trajectory, I think 500 strike to December 25 is an option if you are very high risk appetite, because you get rewarded if you're right with these, like a lot. But any hiccup, you have 100% loss. Not 100% because we would get out before, but bad loss. Oh, that was scenario 2. So scenario 2, I would reduce basically if you're flatlining with the share price into June 1st, I would also reduce lead portfolio, but not by 50%, but only 20%. So they make up, 35 to 40% of the total portfolio. So I'm reducing risk, but not as much because, it's not as smart. And then you do basically the same thing. You track it day by day and go all in. If the stock goes down, from here, which I think is very unlikely, but if the stock goes down, I would do nothing. Because if it goes down, the upside just becomes asymmetric. Unless there's some big macro problem, but if the market stays stable or goes up and Tesla goes down into June, I would not do anything, because then you have huge asymmetric upside. So that's kind of the situation as I see it. It's very important that we track this very closely. It's all about understanding the Robotaxi, the actual EBITDA projections, and to understand that in this scenario, in 2027, Robotaxi in the fast scenario could already deliver $30 billion in EBITDA. That's what no one has on the radar. Even in the slow scenario, in 2027, it's going to deliver 20% or 30% more EBITDA than the entire company did in 2024. So I think there's a reasonable chance we are here. And these don't get it wrong, right? These things are forcing functions that will force every Wall Street analyst to follow suit.